You checked your account, saw silver slammed into the high 70s, and thought, how is this real? Because outside your screen, the world looks anything but calm. Energy chaos, geopolitical risk, supply chains straining. Yet the safe metal is dumping like a meme stock. That whiplash is exactly what triggers bad decisions. So pause, exhale, don't mash the sell button out of panic. What you're seeing is not the physical market suddenly collapsing. It's the paper layer distorting the picture on purpose. Today's candle is built to do one job: shake your emotions, weaken your patience, and coax you into giving up real exposure at a bargain right before stress shows up in the supply chain. Price is loud, fundamentals are stubborn. Welcome back to Vantage Economics. Here we slow the noise down and walk through the numbers and the mechanics, not the headlines. And a quick note, I'm not selling signals, I'm not soliciting money, and if you see impersonators in comments, report them. This is market education, not personal financial advice. Verify everything and talk to a qualified pro for your situation. Now, what actually set off this drop, and why are experienced players not rushing to dump physical exposure? Let's trace the trigger, because it didn't start in metals. It started with US macro data that hit this morning. The government's second estimate for Q4 2025 GDP landed at 0.7% annualized growth. That's a 0.7 point downgrade from the earlier 1.4% estimate, below the 1.5% consensus, and a steep slowdown from Q3's 4.4%. At the same time, inflation measures stayed sticky. Q4 PCE at 2.9%, with core PCE at 2.7%. Growth sliding towards zero, while inflation remains above target. What do economists call that combination? Stagflation. And it's a nightmare setup for the Fed. Here's the chain reaction that matters. When markets start smelling stagflation, traders assume the Fed can just simply rescue growth with quick rate cuts because prices are still too hot. That fear pushes treasury yields higher, especially the 10-year. And when yields jump, the dollar tends to strengthen. Today, the dollar index surged. Now zoom out and look at how the paper plumbing works. Gold and silver are priced in dollars. And when dollar strength spikes, a huge amount of systematic trading, algos, quant funds, high-frequency systems, responds the same way: sell paper metals. The code isn't reading the world, it's reading relationships. Dollar up, metals down, execute. So a wave of futures contracts hits the market. Claims on metal the seller doesn't T have and doesn't T plan to deliver. That flood of paper supply smacks spot lower into the 70s. And what happens next? Retail sees the red, feels the stress, and sells real holdings into the downdraft. That's the setup. That's the trap. So while the screen price is falling, what's happening in the physical world today, right now? We're about 2 weeks into a major Middle East conflict. Shipping lanes are under pressure, and the Strait of Hormuz, critical for roughly a fifth of global oil trade, has effectively turned into a choke point. Energy risk is not theoretical. Emergency measures and workarounds are being discussed just to keep flows moving. Why does energy matter for silver? Because silver isn't produced by wishful thinking. It's mined, crushed, refined, shipped, an energy-intensive chain from dirt to bar. When crude threatens $100, the cost to pull ounces out of the ground rises fast. Mining firms don't care that GDP was revised to 0.7%. They care about diesel, electricity, and labor. So you get a widening gap. Physical cost pressures rising, while the paper quote gets pushed down by mechanical selling. That disconnect is the distortion. And it gets more interesting when you watch inventory behavior. A paper smackdown doesn't magically refill vaults. Registered inventories haven't suddenly reversed course because a chart turned red. Industrial demand, solar, electronics defense, doesn't evaporate because a dollar index popped. In fact, many industrial buyers treat sharp sell-offs as a coupon. If you were a manufacturer needing steady supply, would you wait, or would you lock in discounted feedstock while you can? This is also why silver often falls harder than gold in these moments. Silver has that dual identity, monetary metal and industrial input. In risk-off bursts, it can get hit more aggressively. When that happens, watch the gold to silver ratio. Today, it expanded sharply, back above 63. If you followed this space, you know what that stretch can signal. Silver gets cheap relative to gold, like a band being pulled tight. And when it relaxes, the snapback can be violent. Now let's talk about PSLV specifically, because if you hold it, you need to understand what you actually own. PSLV, the Sprott Physical Silver Trust, is not the same structure as SLV. SLV is designed to track the paper price and sits inside a system where everyday holders can't just redeem for bars. PSLV, by contrast, holds allocated, audited silver stored at the Royal Canadian Mint. Different vehicle, different exposure. When paper spot gets shoved into the 70s, PSLV's net asset value drops with it because it's tied to spot pricing. Your app shows red. But here's the key. The number of ounces backing your shares didn't evaporate overnight. The metal didn't teleport away. Only the dollar label changed because paper trading reacted to a macro print. So ask yourself, if you dump PSLV in a fear moment, what are you really doing? You're surrendering a claim on allocated metal during a period when energy constraints and supply stress are building. And who's on the other side of that trade? Often it's a buyer who understands the mechanics better and who is happy to take your position at a markdown. That's why these flushes exist. Create volatility, amplify the panic, paint the tape red, let talking heads proclaim doom, and wait for forced sellers. Then stronger hands accumulate. They don't need you wrong, only emotional. So here's a clear framework for the next 72 hours. No drama, just signals. First, stop staring at minute-by-minute spot. In this window, the spot is being steered by yields and the dollar more than by physical conditions. Let the machines play. Second, track energy and shipping risk. If the geopolitical squeeze stays active, the floor under production costs doesn't disappear. Paper can diverge from physical reality for a while, but it can't do it forever. Which one do you think wins in the end? Third, watch PSLV's discount or premium to NAV. If paper stays suppressed but serious buyers accumulate, that discount can shrink or flip into a premium. That shift is a powerful clue that participants are treating the dip as an opportunity, not a warning. Fourth, check your own timeline. If you bought silver expecting a smooth ramp upward with no gut checks, you picked the wrong asset. Silver is famously wild. It will test conviction repeatedly. The way you survive the swings is by anchoring to structure, deficit dynamics, inventory trends, and the real-world inputs like energy costs. If those haven't broken, then the move you're watching may be more theater than truth. If this breakdown helped you think clearly instead of react emotionally, hit like and subscribe here on Vantage Economics. That single tap helps this reach other holders who are staring at the same red candle right now. And if you want more of these calm, data-first walkthroughs as the next delivery window approaches, stay with us, because the next surprise often arrives when everyone feels most certain. As always, verify the GDP release, watch yields in DXY, read the vault reports, and talk with a qualified professional before making decisions. The goal is to stay informed, not impulsive. See you in the next one.